In today's little video, I think it's just going to take a few minutes. I'd like to explain one thing about the new financial statements, and it would be true about the old financial statements as well, but we want to make sure that we are clear on the cash flow statement. The cash flow statement is particularly a problem to set up. If you remember back from your school days how hard it was to do a cash flow statement, and everybody struggles with that chapter of good old intermediate accounting. But this, it is particularly hard in that we have to make some assumptions in order to make an automatic cash flow statement. The only other alternative and more complex type of solution would require every transaction to be coded not only by account but by where it shows on the cash flow statement. Well, we in the Sun Plus world, we just think that is way too much trouble to have to worry about that for every transaction. So what we do is that we make a cash flow statement built on reasonable assumptions. And as long as those reasonable assumptions hold, you get a correct cash flow statement. However, if they do not, if the assumptions are not true, then your cash flow statement, even though it is balanced and looks good, is basically wrong. And so the purpose of this video is sort of to explain the assumptions that go into the construction of the cash flow statement and the necessity for the controller, the preparer of the financial statements, to pause a minute before they release the financial statements to make sure that the cash flow statement is telling the truth. Okay? It will balance, and unless we've done something wrong, the cash flow statement will come up with the right answer at the end. It will just be wrong. Let me explain what I mean. All right, in order to do this, I would like to start off by reminding you how a cash flow statement is made. And so the handiest way I can do that is to grab the instructions on how to make a cash flow statement from the accounting manual. So here's Appendix 6B in the cash flow statement. Appendix 6B from the accounting manual. And now the purpose of this video is not to train you how to make a cash flow statement. The accounting manual does that very adequately, and also there's plenty of information on the internet and textbooks and so forth. But I want you to understand how a cash flow statement is made, how we then make it automatic in the Sun Plus financial statements, and you could see that we have a real potential for misleading information when you're done with this video. A cash flow statement is done by taking the current balance sheet values and putting them in the first column. This is labeled current year, but this would be current period, balance of the balance sheet, and then beside that putting the end of last year. So this is, if we were doing the cash flow statement at the end of March 31st, this would be March 31st of 2014, and this would be December 31st of 2013. Okay, so this is not apples to apples here. This is the current balance sheet figures in this column, and this is the end of last year figures in this column, and then you take the net change. Okay, and basically, if you think about, since the balance sheet balances, and if you took the net change, let me roll up real slow here, okay, and you went through all of the net changes add up to zero. Okay, if you think about that, this is in balance and this is in balance as far as assets equal liabilities in capital, net assets, then if you took the changes would have to be a total of a net change of zero. Okay, let's see if I could show it here. Here is the total net changes for the assets of $21.97, and here is the net changes for the liabilities and net assets of $21.97. So if this balanced and this balanced, then the changes have to balance. And the goal then is to take every one of those changes and help it find its way to the cash flow statement. Okay? If you think about it, if we brought all of these changes and the balance sheet to the cash flow statement, they would balance the change in cash right here. Okay? So if we've brought all of these changes that have happened in the balance sheet to the cash flow statement, they would total the change in cash, which is what we're trying to calculate on the cash flow statement. Okay, so we have to help each one of these find where they belong on the cash flow statement. So let's just take a very simple one. Accounts payable here went from 356 down to 261, so it went down 95. Okay, and we have a legend here where we've kept a map of where things are going on the cash flow statement. And so this is 1F. It's just a coding used by the preparers of the accounting manual. It means it's just a indexing. Okay, and it's cash flow from operations. And so if we go down to the cash flow statement, we will see 95 on the cash flow statement. It's found its way. So let's go down to the cash flow statement and see the cash flow. Right here we go, and we have cash flow from operations, and we look around here, decrease in accounts payable for 95. Okay, so it has found its way to the cash flow statement, and if everything finds its way to the cash flow statement, the difference would be the change in cash. Okay, if all of those differences from the balance sheet find the way to the cash flow statement, they will have to equal the change in cash. So that illustrated a simple one. Okay, a simple one where we have a 95. Okay, that change in accounts payable, and that made it down, and so we put a check mark, and that we've got this difference here of 95 down to where it belongs on the cash flow statement. Okay, I think for the fun of it, and not to belabor it too much, we need to get another example over there. And so here's change in accounts receivable, went up by 12. Okay, and so we've got to get that to the cash flow statement, that 12. So we come down here, okay, to the cash flow statement, and we put that 12 on there. And we have a decrease in accounts receivable here somewhere. Right there, it's 11,754. It's illustrations are a little bit troublesome in that the total here are in full numbers and the others just rounded by thousands, but you get the idea. Okay, so far that's interesting, but you already know how to do a cash flow statement in theory at least. And so what does it mean for the accounting the new financial statements? Well, the new financial statements have taken these differences and put them on the cash flow statement, assuming some basic fundamental principles. So for example, accounts receivable always and obviously goes as a cash flow change in cash from operations. Okay, no big deal. But here we have a complex one, for example, the change of investments. Okay, well, the change of investments, if we look the way that investments appear on the cash flow statement, the difference between the change in the year show a couple different places. And so we have to make some assumptions about what has happened here. Okay, and so here is the point of the entire video. Where the trouble comes from that impacts our automatic financial statements is that if you have any figure that has several dynamics working at one time, any one of these rows from the balance sheet has several dynamics going on at one time. For example, under investments, we have purchased investments and we've sold investments. Under notes, non-operating fixed assets, we have purchased new fixed assets and we've had depreciation. So what we have to do is, when we make automatic financial statements, is make some assumptions. Why did that number go to that number? Why did the 541 go to 526? Well, we have two dynamics going on. We purchased investments and we've sold some investments, and each of those dynamics are shown separately on the cash flow statement. Okay, so you're clear on that. We went from 541 to 526, and the difference is 15, and this is slightly complicated to look for. Okay, but we go to the cash flow statement and we see we have investing activities, and we have investments that are maturing, and we have investments that we have purchased. Okay, and we may have some more investments. We may have a gain on investments. Those things have to be broken apart. And we can look here, we see proceeds, 3E, 2E, and 3F. You see these things are getting combined into several different areas. And so what we have to do is, I have to, when I make the automatic financial statements, is make some assumptions that help me separate those conflicting dynamics that are happening on each row of the balance sheet. So, for example, investments. I assume when I make the financial statements that all debits to investments were purchased to investments, and all credits to investment are revaluation, and all credits to investments were sales to investments. The same sort of thing is going on in the plan assets. We have to assume that we have three dynamics going on in plan assets. We have purchase of investments, plan assets, we have sales of plan assets, and we have depreciation. So if I take the difference between these two numbers, remove what was caused by depreciation, take the debits to the plan asset accounts, meaning that they are purchases, and the credits to the plan asset accounts besides depreciation, meaning they are sales, then I'm able to make an automatic cash flow statement. And in general, those assumptions are true. Debits to plan assets are normally purchase of plan assets. Credit to plan asset accounts are normally sales of plan assets. And that will, using that assumption, I'm able to make an automatic set of cash flow statements. However, it is not always true. Okay, so if, say hypothetically, I bought a plan asset for $8,000, and for some crazy reason I recorded it to $10,000, and then I said, oh, that's not right, and I reversed that incorrect entry and recorded the right entry. Well, the credit of the reversing shows up as a purchase. As a sale, a disposal of the plan assets. So cash flow statement is a starting point for gathering all the information. And the cash flow statement is correct if the assumptions are correct. If the assumptions are incorrect, then the cash flow statement, even though it balances, is incorrect. And so now, in order to really illustrate that, let's just go and look at the cash flow statement, and I can show you what I mean. Okay? All right. So here is our cash flow statement already extracted. And so, for example, purchase of investments here, in this sample data here, I'm saying we have purchased 9,020 of new investments. Well, that would be all of the debits going into the investment account. Okay, here we have increase of purchase of planned assets. Here's $12,489.90. That's the purchases. That's the debits going into planned asset account. Here is notes receivable. Increase in notes receivable, $12,305.19. That's the debits going into notes receivable. And if that is true, all the debits were new notes receivable, all these debits and planned assets were purchased, and all these debits and investments were new investments, then this statement is correct. Okay? But if there were any other debits into those accounts, they will show up here as purchase of investments. So let's think about that. If we've disposed of a planned asset and we made a mistake in recording the disposal and we debited the planned asset account, that debit shows up here as a purchase. Okay? And so it would still balance. The cash flow statement would still balance, but we would have cash flow from disposal of investments, and we'd have cash flow from disposal of planned assets coming in that would be overstated, and the purchase would be overstated. Okay? And so what you have to do is, if the assumptions, and I'm going to go through the assumptions with you in a minute, if the assumptions are not true, you've got an overstatement in one part and an offsetting overstatement in another part. You need to push these out to Excel and remove those conflicting or offsetting overstatements. Okay? All right, so let me restate that because I feel like this might be very confusing. This debit, this $12,489.90 would be a debit for all, it is all the debits to the plant asset account. Okay? If we had any sales of plant assets, credits to the plant assets, they would be proceeds from sale of planned assets. It would be an account, a row up here. Okay? And if the debit assumption is correct, all the debits are purchases, and the credit assumption is correct, all the credits besides depreciation are sales, then the cash flow statement is correct, is properly done. However, if the assumption is not correct and you've made an error correction, which is what the only thing I can think of that would cause you to do something other than the assumption, and you've made an error correction, then your proceeds from the sale of plant assets and the purchase of plant assets would both be overstated by the amount of that error correction. And you would have to take it out to Excel and remove those two overstatements. Okay, so we have the cash flow statement here, and it was built, and I guess the point of the entire video and the previous explanation I've given so far may have confused things, but in order to have an automatic cash flow statement, we have to have some assumptions about what is going on in the accounts. If these assumptions are not correct, then the cash flow statement, even though it balances, will have offsetting errors in it that make them misleading. Okay? Here are the assumptions that went in to the cash flow statement. They're listed at the bottom of the cash flow statement, and they all disappear automatically when the cash flow statement is extracted. So here are the assumptions. All credits to the investment accounts were sale of investments and not error corrections. The second one is that all entries to unrealized gain and loss were balanced against entries to the valuation account on the balance sheet. Okay, you might have to look at the investments video, but you record the gain and loss by debiting and crediting the account 119 that starts with 119, and then debiting and crediting the account 712. Okay, and those are the only entries going into the 712 account are entries that are countered with entries, debit or credits to 119. The next assumption is that the debits in the investment accounts were all purchases, that there were no error corrections going into the investment account. The sale of plan assets were all recorded through account 762, which is where we're supposed to be recording the proceeds of sale of plan assets, account 762. All disposal, the next assumption is that all disposals of plan assets are recorded using the automatic disposal functionality of the asset register and are not done directly into the accounts. Okay, if you make it directly into the accounts, bypassing the asset disposal functionality, asset register disposal functionality, then you've messed up your cash flow statement. The next assumption is that all debits of long-term debts on long-term liabilities are payments, and all credits in long-term liabilities are new debt. No error corrections on either one of those as well. All debits to long-term debt are payments, and all credits to long-term debt are proceeds from new debt. That is the assumption. Now you might say, well, what if I know one of those assumptions are wrong? It's very simple. What you end up with if you have a violation of one of these is you have an overstatement in two places. The best way to show it is with these last two right here. All debits to long-term liabilities are considered, all credits to long-term liabilities are considered new debt. All debits are considered payments. If you have an error correction that is not really a payment but really a reduction of the proceeds, then your payment will show and your proceeds will be overstated, and so the two offset each other, so your cash at the end balance. So what you have to do to fix that is to extract these statements, take them out to Excel, and remove that error correction by reducing the payments and reducing the proceeds. Okay? So it is a little bit complex, and the most important thing is for you to know that if the assumptions here are not true, then your statements are incorrect and need to be patched up before you start handing them out to your board. Okay, and so thank you for watching this video, and if you have any questions about this, feel free to email me and I'll try to help you get straight on it. Thanks.